Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. So this week we are setting off on the next 100 editions of the Moneymakers podcast, having just clocked up our 300th anniversary last week. And I'm delighted to be joined again today by Andrew McHattie, the editor of the Investment Trusts newsletter, to talk about some of the more recent news announcements from the sector. It's been a relatively quiet period, I think it's fair to say. No harm in that. But of course, there are still a lot of global things going on. Situation in Israel, of course, dominating a lot of headlines. And the escalating, as of today anyway, escalating trade war between the US and China, which could become more serious than it is at the moment. We don't know. But anyway, that's the world, that's markets for you. We're going to concentrate on what's going on in the investment trust sector, our own little niche area. So, Andrew, let's talk about some M&A news and how it's impacting the biotech sector. I think we all know that biotech has been a bit of a problem area until recently, but it has started to move in a helpful direction. So perhaps you'd like to fill us in on a couple of the news announcements that you've picked up on, which are talking to this theme.
Yes, thanks, Jonathan. And first of all, I must say I'm delighted to see your podcast going from strength to strength and getting past another milestone. So congratulations from me on that. Yes, in spite of markets being noisy and President Trump, of course, getting involved as he so often does, actually companies and markets are just getting on and performing as they usually do. And we've seen this really interesting uptick in M&A in the US biotech sector. And I think I've been waiting for this, really. I remember about 3 or 4 months ago, I was researching the US biotech sector quite a lot because it seemed to me it was really lagging the broader market because US investors in particular were all keen to concentrate on the tech sector instead. But actually now it's been catching up. And I think it's really being driven by this M&A. And there's been a huge spate of takeovers. So, for example, International Biotechnology Trust has now seen 8 M&A deals in its portfolio this year. The latest of those was Novo Nordisk taking over Akero Therapeutics for up to $5.2 billion. These are big deals on the whole. And that's just the latest in a long string of these. So it's interesting. International Biotechnology Trust and RTW Biotech Opportunities have been particular beneficiaries here, and also Biotech Growth Trust. And all three have really seen their NAV accelerate quite dramatically. So over 3 months, if you look at International Biotech Trust, I think its NAV is up 28%, for RTW 26%, and Biotech Growth 36%. So they've really had a big bump from this. So it's been tremendously helpful.
What's driving this, do you think? I mean, obviously we know that the healthcare sector in general has been affected by the Trump administration and an interesting appointment as head of the relevant government department in Washington. A man whose views are not shared everywhere around the world. That's Robert Kennedy Jr. But what else has been driving this, do you think? Is it that the uncertainty has been lifting, or is there excitement about the technology itself that you think is drifting this? Do we know?
Well, I think there's a longer term driver here because M&A is not unusual in the biotech sector at all. Effectively, this is what happens in this sector, that the large incumbent pharmaceutical companies need to buy in the research. They don't do that much of it themselves. So they rely on these smaller companies developing really good drug candidates, going through the research phase. And then when they're successful, they tend to get bought. And I think this just happens in a lumpy fashion. And actually, I've spoken to managers about this in the past, and they said there's a conference season. And it's during the conference season that everybody gets together. They talk about all of these latest developments, and they tend to make these decisions. So I think it's just a cyclical phase here that the market's going through. And there's nothing too unusual in seeing quite a bit of M&A. But what is encouraging to my mind is that the uplifts we've seen have been really significant. Clearly, they vary a lot depending on the takeout prices, but these trusts are really seeing quite significant increases in their NAVs as a result. So it's not just business as usual. I think they're getting slightly more for their money now. And so we're seeing this considerable momentum, I think, building in this sector, which we're seeing in other ways as well. So we're also seeing this in some of the unlisted companies raising fresh money through new financing rounds. And they're doing so again at a very significant uplift to the previous valuations. So this is all very helpful.
So that's interesting. Perhaps we could also have a look at the discounts involved in these trusts because they're still quite wide. I think reasonably wide. You'd think there may be more potential there. Of the two you mentioned in particular, IBT and RTW, the latter I think is on a discount of somewhere between 20-25%, and International Biotechnology somewhere around 10%. Is it something like that? Have they been moving? And do you think that's another factor that could play in if this trend continues?
Well, I'm surprised they haven't really moved. No. So they haven't really come in. And you're quite right. So IBT and Biog are both trading around the 10% mark, which I think is quite decent value. And then to my mind, you do have this outstanding discount on RTW. And to some extent, I can see that's justified because RTW is more focused on early stage investments. So it is a higher risk proposition. But there's one extra element here which I really like. So RTW only announces its NAV once a month. And on my computer here, I've got a little model actually where I look at their big holdings and I model their current NAV, which is often significantly different. And so I think actually the NAV for RTW is even higher. So that discount is in fact even wider at the present time. And to my mind, that is an opportunity and we could see a bit more narrowing here. So yes, I think there's scope for more of an uplift.
Well, that's an interesting and positive development. Let's talk about another trust, which is, well, very interesting trust, this one. And that is Manchester and London, ticker MNL. This is a trust that has, I think it's fair to say, the most lopsided portfolio you'll find anywhere in the investment trust sector. Very big holdings in tech, particularly the big American tech companies, two in particular. But it's been in the news for rather different reasons. So perhaps you'll fill us in on what you think might be going on here.
Well, this is an interesting one for sure. And it is a bit of a maverick trust, isn't it? So I'll just pick up on exactly what you were saying about this lopsided portfolio. It does have more than 40% in NVIDIA. So it has 41% in NVIDIA and another 23% in Microsoft. So effectively, you've got pretty much 2/3 of the portfolio in two stocks. So this is not quite the diversification we normally expect from investment trusts. This is very focused indeed, and clearly higher risk as a result. But what's going on now is not related to that at all, really. It's to do with its own structural problem. And this is because the manager of the trust, Mark Shepherd, and his management company own 62% of the trust. And that's great in a way. It's lovely to have a manager with so much skin in the game. But this is now causing an issue because the trust must keep 35% as a minimum as a free float in independent hands to maintain its investment trust status and keep the tax benefits. So for that reason, Mark Shepherd's not buying any more shares. And also the trust has stopped its buyback program because it doesn't want any more concentration of his holding. But this is not going to go away unless the trust gets bigger or changes in some way. So there have been several reports in the press about Manchester and London trying to seek a merger partner and to get together with some other trusts, really to dilute Mark Shepherd's holding a bit to overcome that problem. And that could work for some other trusts, maybe those that are being targeted by Saba. So that's the story here.
Yes, that's an interesting one, isn't it? I mean, another benefit for him could be that, of course, he may decide that it's a good moment to diversify away from his rather concentrated holdings because he might have a view about NVIDIA and how well it's going to go on performing. We don't know about that, I don't think. So I can see the benefits to him would be twofold. Not so clear-cut what the benefits to others would be to merge with him, because presumably he'd want to keep in charge of the portfolio unless he wants to sort of retire, start cashing in his not insubstantial pile of chips. I mean, it's a £300 million market cap investment trust now, this one, trading on a discount, and he owns 60% of it, so he's done very well out of it, shall we say. Very well indeed. So I wonder what that foretells. And I've seen some skepticism in the analytical community about, as I say, whether anybody would actually want to do a merger with him at the moment.
I'm agreeing with the skeptics here because I can't really see what's in it for another trust, because it doesn't really make a lot of sense to merge with Manchester and London while it's on a 29% discount, because actually you're not getting great value for your money there. And I'm not sure that it really is going to be that attractive for other shareholders either to buy into this trust, which is so unique. There's nothing else quite like it. So you're not going to be merging into anything similar to what you already own. So I don't know. And unless there's a trust in a really dire situation and it needs to do something pretty desperately, I'm not convinced that Manchester and London is going to be an attractive partner.
Is it fair to say that one of the reasons why Berkshire's been able to develop such a large shareholding is that, not everybody would want to invest the way that he does? In other words, there's not a lot of other demand for this particular trust, even though it has performed very well. Of course, it's ridden this big tech wave very, very successfully, albeit with a big sell-off between 21 and 23, which is what, of course, always happened to everybody else, including Scottish Mortgage and the rest. But it has got a very good long-term track record. Let's talk about another trust where perhaps the significance of the management's investment is important, and that's Cordiant, a digital infrastructure trust.
So, yes, Stephen Marshall here, the chairman of the managers of Cordiant, has bought another 551,900 shares, which is a big number. So he now owns 13.8 million shares, and they're just under £1 each, to give you context. So, again, a very large shareholding. But in this case, it is nowhere near as significant as Mark Shepherd's holding in Manchester and London, because Cordiant Digital is a large trust. It's around £1 billion of net assets. So the holding is significant, but it's certainly not controlling. It's nothing like that at all. And I think it raises an interesting question here of how significant this director shareholding is. Now, I think there's some wonderful research done into this, and we're probably all aware of the terrific annual report produced by Investech called Skin in the Game. But I think one of the interesting elements that's come out of that is that there's very little correlation actually between the performance of investment trusts and the holdings of the management teams or the boards. So I don't know. It can give you a warm, fuzzy feeling, maybe as a shareholder, to know that the chairman is putting more money in. And I don't think that's a bad sign at all. But equally, I don't really see that as a particular reason for buying.
Right. I mean, he was on the podcast not so long ago, actually, Stephen Marshall, and he made a good case for why Cordiant has been perhaps unfairly punished by the markets, not least because of the comparison, well, the being infected, if you like, by the problems that Digital 9 infrastructure have had. But the shares are doing very well. I mean, they're up from a low of around 60p. They're back up to around 100p now, which is around the issue price. And they're trading at a discount. So I guess he would see it as a vote of confidence, I suppose. One of the troubles, as you say, with getting information about how much equity the managers of a trust own is that, of course, you don't really know anything about the individual circumstances. So you don't know whether it's a big or a small amount. If Stephen Marshall happened to have in his back pocket, 200 million like Mark Shepherd, then maybe it wouldn't be such a big deal. But I suspect it isn't quite like that. Do you like Cordiant digital infrastructure? I mean, this doesn't change your mind, as you've said, but do you think it's an interesting one?
Well, I was conscious while I was speaking before, actually, Jonathan, that maybe I sounded a bit negative about it, and I certainly didn't mean to be, because I do like it, actually. It's a perfectly good trust, and it's interesting, actually, its portfolio is in some really hot areas. So data centers, communications towers, fiber optic networks, we can all see the need for these. They're all growing areas. Actually, the trust seems well managed to me. It's doing very well. And I think it has been unfairly tarnished by being in the same sector as Digital 9. It's on a wide discount. It's a 27.8% discount, in common with quite a few other things in the infrastructure sector. And I think it's sensibly structured. So it's not all about the yield here. The yield is about 4.5%, so quite decent. But this trust is actually much more about growth as well. And so I think it's a good, sensible trust. I do like it. And I think actually there's no reason why you wouldn't take some positivity from the chairman's participation as well.
Well, we seem to be discussing a lot of trusts that have been on the podcast recently, but one that was on just a few days ago was Golden Prospect Precious Metals. And that's obviously had an astonishing run recently. It's the best performing investment trust of all this year to date. What are your thoughts on this sector and how the various trusts that have an exposure to gold have been performing? One of them, CQS Natural Resources, was a Saba target, I recall, but they exited from that position just a few weeks ago when that trust did a tender offer. What are your thoughts on this particular sector?
I think we have to talk about this, even if we're going over old ground again, because gold has been the big mover. It's been the biggest asset shift that we've seen over the summer and this early autumn period. And the gold price has been absolutely tremendous. It's been so strong. We wondered if it would possibly be able to break through the $4,000 per ounce mark. It's surged through that, and it's heading towards $4,300 an ounce now. And I've looked at this several times actually and written about it. And it seemed to me that there really was a perfect storm here for gold because there were lower interest rates, persistent inflationary pressure, central banks buying gold as a way of diversing away from the US dollar, investor demand for ETFs, geopolitical issues as well. So this was all driving the price of gold up. And that's why it's traveled so far and why it's pushed up the shares of Golden Prospect Precious Metals by 162% over the last year, which is just fantastic. And this trust is not alone. There are other ways of getting exposure. One of those, which you referenced there, was CQS Natural Resources. And there was a lovely bit of schadenfreude there about the exit price for those, including Saba, who decided to leave through the tender offer, which was at a massively lower price than the current share price. But they have good exposure here. I looked at their latest fact sheet and it said at the time precious metals were 46% of the portfolio, probably a bit higher now because of price movement. There's also BlackRock World Mining, where the exposure is slightly lower. Gold was 36% at the time of the last fact sheet. So these have all done well, actually. The commodity sector has been the best performing sector of all over the last quarter. And I can see it going a bit further yet. I'm not sure that any of those factors driving the gold price have actually gone away. So we'll have to see. And I listened to your podcast as well, and I think it was a very valid point that the managers of Golden Prospect were making, that actually they're investing, of course, not in gold bullion, but in the gold mining companies. And there's a bit of a lag there. So there could be some catch up from those companies still to come.
History suggests that investing in gold mining companies is quite a hard haul over the medium to longer term. It tends to be very cyclical and they never quite make as much money as you would think they ought to do. But in the short term, it's certainly been a bonanza. And they are catching up now, which suggests that the price of gold has moved so far that it's bound to have a positive impact on them. Of course, the problem is, and the reason why many people, they're not me, I hasten to add, don't like gold is that you can't really value it. The bullion, you can't really value it because it's got very little intrinsic value. It has some uses in jewelry and so on, and some industrial processes, but basically it hasn't got much, and therefore the price could be what you want it to be. And that's, of course, why some investors never invest in it. But it has been on a roll, and the reasons for it are very, very clear, I think. So it would be a brave man who said that this is going to carry on at this rate. I mean, the graph is beginning to look a little bit rising exponentially, which is always a worrying sign. It looks massively overbought, all those sort of things. But it has a place in portfolios, and it's telling us something about the future, maybe, that we ought to be taking account of.
I think that's right. And clearly, it's becoming more risky as the price goes up. But of course, one factor that we haven't even talked about yet is the possibility of a large setback in other financial markets. And there have been quite a lot of warnings about this. The Bank of England has warned about it. The IMF has warned about it. And if we were to see a considerable setback in the US equity market in particular, and perhaps allied to that, a fall in the dollar, I think we could see much more demand for gold. So yes, who knows? It's going to be a very interesting one to watch. And there have been forecasts I've seen saying it's going to get to $5,000 an ounce. And whilst those seemed quite fanciful a while ago, they're not looking so fantastic now.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Let's next go back to the commercial property sector. We haven't heard much about the commercial property sector for a while, frankly. A lot of trusts have left the investment trust world through deals of one kind or another, or liquidations in one or two cases. But tell us what you picked up on this week. There's recent news coming out of Big Box REIT, which invests in those big logistics warehouses that we see dotted around the road network in the UK. What's been going on there?
Well, I've been pretty negative about the REIT sector, and it really has been shrinking so rapidly because it's so sensitive to higher interest rates. And I could foresee actually the sector almost disappearing completely from our investment trust world. So against that background, I was really pleased actually to see that Big Box has found a way to expand. And I think this is indicative actually of the need for some slightly more creative thinking when it comes to the corporate structure here. So BBox has actually found a way to acquire £1 billion worth of assets from Blackstone. You might remember actually that Blackstone just outbid BigBox for Warehouse REIT. And so there's some irony here. But anyway, this deal is going to be done. So BigBox REIT is going to buy £1 billion worth of assets. And it's not doing that all by raising new debt. Part of that is, so around 650 million of that is new debt, but the balance, which is quite significant, is going to be taken in equity by Blackstone. So they are being paid in BBox shares, which I think is really interesting. And those are being issued at 161 pence to Blackstone. So that's higher than the current share price, which is 144, but it's lower than the asset value, which is 192. So you've got to get your head around that. And what that means is that it is slightly dilutive for existing shareholders, but it's probably still a good deal. And I think actually, given the difficulty for all listed REITs of raising more money while their shares are on these big discounts, and in the case of Big Box REIT, it's on a 24.9% discount. This is very encouraging, and it's nice to see this trust working to find a way around its difficulty with the discount.
So this could be a deal that works for both sides, right? I mean, well, I presume it is, otherwise they wouldn't be doing it. But thinking back to things, like London Metric, when it acquired some of the investment trusts, they basically sold a huge chunk of assets. They just kept the bits that they wanted to keep. And you imagine there might be something like similar happening in this case, where Blackstone had his eyes on some of the warehouse REIT properties in particular, and is happy to trade a big chunk of them back to the known buyer, in the case of Big Box. Yeah, so it is interesting. And in terms of the rating of Big Box, the share price has been pretty flat for a while. The discount is still very wide at about nearly 25%. So it certainly had to do something, I think, if it was going to move forward and get out of this bind that it and a number of other commercial property trusts have been in. Would you agree with that?
Well, I would agree. And this has been such a problem because if you're an investment trust REIT and you're on a big discount, you're a bit stuck. You can't raise capital. There's pressure on you to repay debt or to reduce your debt load. People are telling you should be buying back your shares, but you can't do all these things because you don't have the cash. And so actually, I think it's incumbent upon these boards to think more carefully about what they can do and what is acceptable for shareholders. And perhaps shareholders are willing to accept a bit of dilution to drive the share price forward and to find some way of growing the assets again and recovering some momentum. So I think this is quite an encouraging precedent, and it's going to be interesting actually to see if other trusts follow suit.
Well, in the context of talking about raising more money, we might also have a look at TwentyFour Income Fund. Another trust has been on the podcast recently, which has been putting its story out quite significantly recently, no doubt, with that fundraising in mind. What do you make of this one and what they've done and why they are doing it?
Well, we've been talking about these tremendously wide discounts across the investment trust sector it seems like we've been doing that forever, but we've been doing that for at least a couple of years. And I think it's a good idea just to step back and have a look at different sectors, because actually the debt sectors are not on wide discounts. And there are some trusts that are high quality trusts that are trading on premium ratings, including TwentyFour Income Fund, which is why it can now think about raising more money. It sees good opportunities in the asset-backed securities it's investing in. It offers a great yield for investors. I think it's 9.6% based on last year's payout. And because it's trading at a premium in the market, it's now offering more shares through an open offer and a placing and a subscription to anyone who wants them. And those new shares are being offered at a 2% premium to NAV. So that's also accretive for existing shareholders. I hope it does well. We'll find out next week how much money it's raised. But I think this is just a useful reminder, actually, that these tremendously wide discounts we're a bit fixated on don't rule across the whole sector. Actually, a lot of debt sectors are absolutely fine, as are some others like UK equity income, Asia income, and Europe.
Yeah, absolutely so. We shouldn't obsess about that. I guess the issue here is that, well, we know that interest rates are probably coming down at the short end of the curve, and they've been going up at the long end of the curve. And we know, without getting too much in the weeds of the various bond markets and their derivatives thereof, they do seem to be quite richly valued, as I understand anyway. So asset-backed securities gives a very reassuring name, but it's not necessarily quite as robust as it appears. Well, it'll be interesting to see how it goes. As I say, the yield is attractive, and I think that's been why it's able to trade at a premium. And as you say, it's not the only one in the sector that's doing that. I just wonder about the timing, whether it's telling us something about the world we're in, but maybe that's just me being rather skeptical of something like that. So that's money being raised, and it has been a very poor year for money raising. So it's a good sign. I mean, it's a sign that the markets maybe are ungumming a little bit. Okay, what about Seraphim Space? You had some thoughts on that one. This is a trust that has attracted quite a lot of interest in the last few months.
I think it's a favourite for us to talk about this one. It does produce a lot of news, but also a great deal of share price volatility. So the shares have ranged between the issue price of 100 pence. It went up initially to, I think, about 130, and then it went down to about 27. So it's been very dramatic, and the share price now is back up at 84 pence. So actually, it's done quite well over the last couple of months. But there's some really interesting specific news here about its largest portfolio holding. So its largest holding is in a company called ICI. That's not the old chemicals company, that is spelled ICEYE. And this is a satellite company that actually came to prominence because they were following Russian troop movements. But it's very useful for a number of purposes, both military and commercial. So ICI is doing very well, actually. And the Financial Times has reported that the company is exploring a new fundraising at a much higher valuation. So it suggested it could raise money at a $2.5 billion valuation, which is probably around double the current holding value in the Seraphim Space portfolio. Now, I say probably because we don't know exactly how much Seraphim owns, and we don't know exactly what price it's held at. But I've seen a couple of brokers' notes, actually, and I'm delighted to say they've done all the donkey work here. They've done some back-of-the-envelope calculations that suggest that should ICI raise money at that valuation that's being postulated, that could imply a 27% increase in the net asset value for Seraphim Space. So a really significant shift. So that's something to watch out for. And actually, this is very timely because Seraphim Space is due to release its annual results with its June NAV on Monday, 20th of October. So we'll get a bit more information then. So the current discount here is already 16 to 17%, but potentially, if ICI gets that uplift, it could, of course, be a lot wider.
Indeed. And maybe the market is moving in that direction in anticipation of just such an outcome. So it's been a popular stock this year, and partly because people began to focus, or the company began to emphasize perhaps, how much of its business is about defense. You mentioned what it's been doing in tracking Russian troop movements, but a very large portion of its business is defense related. And that obviously has played into a general theme built around European space, the need for European defence spending to go up significantly. So it has been in demand. And as you say, it's an interesting situation. And certainly myself, from talking to the company, I think it's a kind of interesting vehicle that should be in the investment trust sector. It launched obviously at a time which is not ideal, went to a big discount and so on, as many recent launches did. But it seems to be well on the way back. So good luck with that. I'm going to ask you next about Saba. We mentioned them a minute ago. You mentioned about their involvement in CQS Natural Resources. They've also disclosed some other recent stakeholdings, new holdings for them. What's the latest one, and what do you make of that one? I know it's a sector that interests you.
It's another one we talk about a great deal, actually, and that's battery storage. Yes, we're back to that. So, yes, Saba has now disclosed a 5% stake in Gore Street Energy Storage. And that's, I think, very interesting. We've seen Saba moving into some alternative asset trusts now. So this is part of that shift. But Gore Street is a really interesting case because there's already been a lot of pressure on the board here with RM actually trying to make changes and being thwarted so far. But RM have a 6% stake and now Saba has a 5% stake. So I think this is increasing the pressure on the board to make sure they're doing everything they can to not only run the trust well, but also to try to deal with this massive discount, which is 44.1%. So there's clearly a lot of value inherent here. And I don't know if Saba's going to help unlock it. We haven't really seen too much in the way of a share price rally here on the Saba news, but I don't know. I think they are going to try and shake this up. And I really don't have much clue what's going to happen next with Gore Street, but I'm pretty sure we're going to be talking about it again.
I'm sure we are. I don't know how closely you track the performance of the various trusts in which we know that Saba has an interest. There have been reports that it's raising a new fund to do more in the investment trust sector. What's your impression overall? I mean, it's interesting that the big seven that they targeted initially a year ago, there's been activity at most of those. A couple of them at least have gone out of business or converted into other kinds of vehicles. What do you assess how they're doing at the moment?
Well, I don't track any of their funds, and you're right, they're thinking about launching a new ETF specifically to invest in UK investment trusts. But my sense is that, and it pains me slightly to say this, I think they've probably done quite well because they have generally been able to exit on favourable terms. I can imagine the terrible moment when investment trust directors realised that Saba has appeared on their share register, and generally they have been able to negotiate exits on a profitable basis. Now, their policy, though, has really evolved because I think they've already extracted a great deal of value out of what we might call the low-hanging fruit in the equity sector. So now I've noticed they're doing two different things. They are now shifting into alternative assets, and that's much riskier for them because they can't hedge these assets in the same way. So I think they're taking a higher risk now. And the other thing they're doing, which is perhaps to mitigate that to some extent, is they are buying into trusts that are entering wind down. So they've got stakes, for example, in Syncona and VPC Specialty Lending. And these are trusts that are winding down and hopeful of realizing some asset value. And I think that's a less risky strategy. So they're going into some different areas here, which means I'm not sure we can extrapolate from how they've done in the past to think about how they're going to do in the future.
Okay, so if you're investing in trusts that are winding down or trying to find an exit, a key factor there is the amount of time it's going to take in order to achieve your objective of unloading what you have or getting rid of it in a tricky market when you're a known seller, which is why we've seen deals happen where trusts have actually sold the whole thing to somebody at a bigger discount you might expect, because the time factor of money is very important. And I dare say that Saba is very conscious of that, being an arbitrager. They'll be putting on even more pressure for boards to get on with completing the disposal. I think that would be their game. I'm sure you'd agree with that. So that's Saba for the moment. I thought it'd be a good idea just to mention one or two trusts that have reported results recently. I mean, there is a generalized feeling, at least that I detect, of people sensing that the investment trusts have started to put their houses in order. Performance has been pretty good over the year to date for a lot of trusts. It is improving. Discounts are coming in a little bit, but not as much as we would like. But there's also been some good results being reported, and I think we don't always talk about those as much as we used to do. And I picked out a couple that I'd noticed at least. which have put in some good numbers. I think the first of those I'd mention would be Fidelity Emerging Markets, which listeners may recall Fidelity took over the management of another trust, Genesis Emerging Markets, 2 or 3 years ago now. And it had a really rough start to life when its Russian holdings were reduced to zero. But it has been coming back, and I think it has a continuation vote coming up quite soon in the next year or so. So it's really under pressure to perform. But it has been doing well. I think you would agree about that.
Yes, it has. And I'm glad we're talking about this. The fact that actually many investment trusts are just getting on with their normal work and doing a good job for investors, delivering returns above their benchmarks. So in this case, the trust released its final results for the year to the end of June. And its net asset value total return was up 11.8%, which was well ahead of the index, up 6.3. And actually, I think that rather understates what's been going on here, because the positive momentum has continued since the end of June. So in fact, the 6-month NAV performance here is really impressive. The NAV is up 38% over 6 months, which is terrific, actually, and puts this trust at the top of the emerging market sector. So it's done very well. And I think that's reflected in the market valuation, which is a 6% discount. And I suppose it's difficult to judge this trust on a longer term basis. As you say, Fidelity have not been managing it for that long. And I've always been a bit frustrated, actually, by the global emerging market sector, because I've always wanted to find one trust that I could just recommend and then just leave alone and sit tight. But it's been hard to find one that's really been a consistent winner. You think you've got one, and then whoever's top of the 5-year chart tends to fall to the bottom soon thereafter. So I'd really like this trust to continue doing well. In the near term, it's been helped by its small and mid cap holdings. And also, actually, quite intriguingly, Jonathan, it's got a short book. So it does short some companies. And I think that really differentiates these managers from many others in the sector. So it's doing something a little bit different, and it's doing well.
Yeah, it's doing very well. I remember talking to them about 2 or 3 years ago after the deal that they took over Genesis Emerging Markets, and they were very bullish, but of course they then had a very tough time, and I think they've still got a bit of work to do to meet their targets, to avoid having to come up with some kind of strategic review or whatever it might be. So that's good news to see that happening. And then the other one I picked out, which I thought might be interesting, very, very, very different, would be River Microcap Trust. River UK Microcap, I think is its proper name, ticker RMMC, which obviously invests only in the very smaller companies area, which is a very hazardous pond to fish in. But tell us about this one. That's another interesting one with an interesting structure.
It is. And again, the clock is ticking here. So there are a few factors here which I think make it particularly relevant to look at this trust. So it is investing in UK micro cap stocks. And that's a tricky thing to do, as you say. And actually, we've seen this subsector shrinking. So Downing Strategic Micro Cap has left the sector. Miton Micro Cap has left the sector. So arguably now it's only this trust and Onward Opportunities left. So it's really interesting to see how it's doing. And it's had a cracking period, actually. So in the year to the end of September, its NAV was up 22.3%. Again, well ahead of its benchmark index, which was up 8.3%. So more than double here. And I think we do see that differentiation quite often here, because it's all about your stock picking. And there's a lot of diverse performances from these smaller companies. And the manager, George Ensor, is very bullish at the moment. He believes that this sector can continue to do well. And he needs it to, really, because this trust is on a deadline. So it has to perform well, basically, in the next 3 years in order to avoid the board proposing a full exit at NAV. And the measure of that is whether it gives capital back to investors in that time, because this is the structural point. This is a unique structure, and it's to do with this trust investing in micro cap companies. That means it can't grow too large, or it can't continue to do it, because you can't put £500 million into tiny companies. So the structure here is that when the assets grow significantly beyond £100 million, the trust gives some money back to its shareholders, which I think is quite sensible, especially because you're giving money back after a period of good performance. So that makes good sense. Currently, the trust, I think, has £84 million of assets. So it's got some work to do to get over that 100 million mark. But I very much hope that it does, because I've been following this trust for a number of years, actually, and it's definitely had its ups and downs. But again, I'm very glad it exists. And I think it's a useful trust to have, and it's doing well right now.
And actually, I noticed the other day looking at some research, this actually is another trust where Saba's taken a significant holding. Actually has 16% of the shares. So I think it's been drawn to the structure, which is for an arbitrageur. This is the kind of structure they like, where you've got a fixed moment in time where something's going to happen one way or another. Either the performance is going to be good or some kind of money is going to be given back, though not necessarily at the price you pay for it. So that's an interesting one too. Well done to those two trusts. As you say, most trusts are getting on with their day job, if you like, which is trying to make money out of their chosen markets, and some are doing well. And I think we should not be afraid to mention that fact when it happens. So, Andrew, thank you very much. We will be talking again soon, I'm sure, about the latest news in a few weeks' time. But thank you for your thoughts today.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.